Okay, good morning. To be respectful of everybody's time, we're going to go ahead and get going here. I'm sure we'll have a few more people trickling in as we start our conversation. But thank you all for taking the time to join us this morning. I'm Ben Mendenhall, the administrator of the Centennial State Liquid Investment Pool, Colorado's newest local government investment pool. It was created by the Board of Trustees to offer another diversification cash management tool to make your job a little easier. And brief background for me, for those of you that haven't met me yet, I've been working with local governments here in the state of Colorado for 18 years. It's hard to believe at this point. I've worked with many of you through a previous team that I was on at another local government investment pool. And we're here to help you. We're here to be a resource for you. And part of our ongoing commitment to our participants and our board of trustees is to have a lot of continuing education. And we were going to be hosting a series of webinars and in-person events over the next year. And we appreciate all of your involvement. And feel free to reach out to us after this call for any questions, or if you have some items that you want us to take a look at. And this webinar is being recorded. So if there's a few items today that you wanted to go back and take a look at, we will be posting a link for this on our website. So with that, I am going to pause and hand over to Will Goldthwait at State Street Global Advisors to introduce himself and his role here at CSLIP. And we're again excited to have everybody here this morning. So Mr. Goldthwait.
Great. Thanks, Ben. Great to be here. Thank you. Thank everybody in advance for your time. Hopefully we can add some value to your day here. My name's Will Goldthwait. I'm a portfolio strategist at State Street Global Advisors. I've been with State Street for about a decade now. Prior to State Street, I was at two different investment banks selling fixed income and cash liquidity solutions to asset managers. And then prior to that, I spent about a decade working for an investment advisor similar to State Street, managing money market and liquidity portfolios. So spent, 30 years in the industry and really excited about this opportunity in Colorado and adding value for you folks on the line. Ben?
All right. So, Will, we've had a lot of chatter on the fixed income markets over the last couple of weeks. Is the Fed going to make a rate cut? Are they not going to make a rate cut? And it looks like we did get a 50 basis point cut yesterday, or I'm sorry, last week. So we have a series of questions for you today that we're hoping to go through. And the first one is, what has the Fed done to date, and has it been effective?
Yeah, thanks. And hopefully everyone can see my screen. As we move through these slides, I got a couple nods of the head. Okay, terrific. So what the Fed has done to date has really been dramatic. They raised rates by 525 basis points from the first quarter of 2022 until the summer of 23. And it was a rate move that we really had not seen, and it's represented by that dark black line there. And so how has that impacted the market? The red circle, I'll draw your attention to the red circle, and you can see that as the Fed raised interest rates, there was a decline in bank, commercial, and industrial loan activity, and there was a decline in residential loan activity, so mortgage loans. So higher rates do work. And that was a really important thing. It is a really important thing, and there's been a lot of speculation on, does monetary policy work? And I think Paul Volcker back in the early 80s proved that to be true. But there also were several other things going on at the same time, and we'll talk a little bit about that.
Great. What has the market gotten wrong, Will, and how are we avoiding that in CSLIP?
Yeah. So really the market has been anticipating the Fed to stop raising rates and actually begin to ease policy rates for a long time. So what you're looking at here is the lighter green line or lighter bluish line is the 3-month Treasury bill 2 years forward. So this is a derivatives contract that we look at, and we look at it to give us some sort of indication of where the forward rate policy is going to be in a period of time. And you can see that line had crossed through Fed funds policy rate well before the Fed had even finished raising rates. And so this is an indication that the market has just been too early in anticipating that the Fed was going to ease policy rates. And so what the market did not take into account was the steadfastness that the Fed was going to operate with to make sure that they tamed inflation. Here's another metric that we look at. We look at Fed funds policy and the spread between the 2-year Treasury and Fed funds. And you can see the red lines indicate when that spread goes negative. In other words, when 2-year yields are lower than policy rate. And you can see back in late 2006, early 2007, that turned negative only after Chair Greenspan was done raising policy rates. Back in January of 2019, that spread turned negative only after Chair Powell was done raising policy rates. But if you push that line all the way over to where we were in January of 2023, you can see that that spread turned negative well before the Fed was done raising policy rates. So the market has just had this reaction function of thinking that inflation was going to be tamed much sooner and much more easily than the Fed thought. And therefore, the Fed had to continue to push higher and basically coach the market into knowing that they were going to be steadfast in their role.
Great, great. Well, what do you think? You think inflation has been tamed?
Yeah, and it's a great question. So inflation has been tamed, and I want to really be careful here because I know that there's some folks on the phone that are thinking, well, wait a second, what are you talking about? When I go to the grocery store, food prices are still exorbitant. When I look at rents are still super high. When I look at sort of everyday living activities, it feels like the price is still very high, and that is true. So we have to differentiate between disinflation and deflation. Deflation is not something we're looking for. It's can be as damaging in an economy as inflation. What the Fed is really looking for is price stability. And that is they want the rate of change to be very gradual and very slow. And so you can see that here. We looked at really some major developed markets, US, Germany, France, UK, Netherlands, Spain, Italy, and inflation has really come off the boil from where it was really at the end of 21 into 22. It's been tamed. And here in the United States, we can see that inflation measures as they currently stand are getting much closer to the Fed's 2% target. And so the last line there, core PCE, that's a number that the Fed looks at very consistently, and that is their preferred measure of inflation, and that is coming down nicely by the Fed standards. And the thing that is important to note here is that the core PCE or core CPI doesn't have to be at 2%. It needs to be trending towards that number. And so recall from the decade of 2009 to 2019, core PCE averaged 1.6% during that period. So 40 basis points below the Fed's target. And that's why we had zero interest rates for so long. So what this means is that we won't end up probably with a neutral rate that is around 2.5%, which is where people are thinking. The Fed will have to keep interest rates a little bit higher than they have been, certainly than they were over that decade of 2009 to 2019.
Okay, well, that's refreshing information. It's good to know that things are starting to stabilize out there. Probably a big question everybody has is what about jobs? What are you seeing there?
Yeah, and this is a really important thing because the Fed has really changed their narrative around employment. So look at that red line. And the thing I want you to look at is if you go all the way back to the late 1960s, that's the last time we saw the unemployment rate in this country that low. So we have a very tight labor market right now. And this has been a real challenge for inflation because with a tight labor market, that means that folks are able to, quit their jobs, find new jobs, demand higher pay. And with those pay raises comes the ability to afford things that are priced higher. And then you have this wage price spiral, and that's something that the Fed is very, very worried about. And so when we saw the tightness in the labor market, what I want you to look at here is the red circle. What this is a difference between, it's between job postings. So this is, all of those job postings that are out there, all of the companies and entities that are looking to hire workers. You can see that starting in December of 2017, there were more job postings than total unemployed people in the country. So this is expressive of a labor shortage. In other words, if you hired every single unemployed person, you would still have companies and entities, municipalities, et cetera, that were looking for workers. And this is a real challenge. And then you can see what that yellow line did in 21 and into 22. What's happened now is with higher Fed funds policy rate, that imbalance is starting to normalize. And so we aren't seeing as many job postings. We're starting to see a few more people unemployed. And this is something that the Fed is concerned about. Now, as much as they wanted to see balance back in the labor market, they are concerned about it. And in fact, Chair Powell stated at a Jackson Hole press conference, they're not looking for nor seeking any further weakness in the job market. So that's why we got a 50 basis point rate cut. And that's a really important thing to notice. Now, at the same time, if you look at the trend line in labor growth, we still have a labor force deficit. So this is something that is really important to recognize. And one of the things I talk pretty consistently about is the need for legal immigration. And I emphasize legal, but the fact of the matter is our natural birth rate in this country is not going to provide the labor force that we need to continue to grow. And so we are going to have to rely on immigration, legal immigration, in order to support our overall economy. And so that's a very, very important thing, and something that proves out in the data, Ben.
Excellent, excellent. Well, it's good to know that the trend is heading in the right direction. Transitioning over to the consumer. I mean, I know I'm feeling it, but do you think the consumer is stressed, and has the consumer overspent? Where do you think we are at that point of the cycle?
Yeah, it's the consumer is a little stressed, and we are seeing savings rates decline. So you can see that spike up during the COVID restrictions that were forcing people to save money. They couldn't go out, they couldn't travel, they couldn't take vacations, and so we had an enormous spike in savings. People have been working through that savings and spending that savings, and we are back down to a very low savings rate. So this is something we definitely keep a close eye on. And in fact, consumer confidence numbers that came out this morning were weaker than expected. And so that's something that we're really keeping a close eye on. And additionally, Ben, the credit, revolving credit. So that's like credit card loans, auto loans. We are seeing a pretty dramatic uptick in leverage. And so this means that people are charging on their credit card and then not paying it off, or taking out additional loans to buy a car, and perhaps not paying those off straight away. So folks are adding leverage to their lives. And again, you can see that dip during the COVID period, but now the red line indicates the scale of this leverage, and something we are a little worried about. Now, if you'd talked to me back in the spring, I would have said I'm really concerned about it because I started to see credit card delinquencies tick up. So this is people that are 30 days or more behind on paying their credit card bills. And that was really moving higher, and it was a pretty big concern. But what we're seeing now is it looks like the consumer is getting a handle on those delinquencies and beginning to pay off. And so they're not continuing to escalate. And that's a pretty important deal because we do need that healthy consumer. 70% of our GDP revolves around the consumer. And so that's an pretty important thing. I'll just take a real quick step back here. One of the things that has been that's created real resiliency in this economic cycle is the fact that people have dramatically delevered or paid down debt from 2007, 2008. And so household balance sheets are now have the same amount of leverage as a German household. And that's a pretty significant statement because Germany is a very austere country. They are very disciplined on their spending. So that the fact that we have the same leverage as those households is pretty significant. It means that everyone's done a pretty good job of paying down debt as a nation.
No, that's great to hear, and it dovetails into more of a comment and a observation that I've noticed over the last couple of months is car dealerships. They have record time of their vehicles sitting on their lots. So I wonder if we're almost at an inflection point based off of this topic where people are going to stop spending, $60,000, $70,000 on a Toyota or a Mazda, or the inflationary pressure on the big ticket items has been astronomical. And I think now it's really starting to trickle down into those dealerships. And who knows, maybe we'll see a correction in the new and used car markets post-COVID. So anyway, just kind of food for thought, extra comment there. Well, let's kind of transition over to the cash markets. How are the cash markets behaving? What are the key things that you and your team are looking out for?
Yeah, it's great. I'll just add one thing, Ben. As far as used car prices, that is one asset class where we are seeing deflation. So we are seeing prices decline in the used car market. And you recall there was such a chip shortage in 2021 that the new car market was significantly curtailed as far as what they were producing. And so used car prices went absolutely through the roof as everyone, needed their car and needed to be moving around once restrictions were lifted. So it's a very important observation, and it's something that consumers should benefit from. So yeah, in the money markets, this is what our yield curve looks like now. And so you can see, and this is actually a little bit dated, it's September 12th. And so it doesn't have the Fed's 50 basis point rate cut on this, but you can essentially shift things lower by 50 basis points across the curve, and you'll get the same picture. So what are we doing right now in the liquidity pool? How are we managing, when we have longer term yields are higher than short term yields? It's really challenging. So essentially what we're trying to do is we're trying to preserve as much current yield for you shareholders as possible, while also trying to extend the portfolio where it makes sense in order to lock in some of those yields. So when the Fed begins or continues to cut interest rates, we can try to preserve some of that yield. And so the yield in the portfolio will not drop as quickly as, let's say, a bank deposit, a demand deposit account whose yield would drop immediately by the entirety of the rate cut. So we try to extend the duration a little bit. We're trying to lock in some of those longer term yields, and we're trying to gauge where we think the Fed will ease and by how much. Right now, it appears as though the Fed, having just eased by 50 basis points, is going to ease again in November by 25, and then again in December by 25. And then subsequently, we think they'll ease by 25 basis points per meeting. There's 6 meetings in a calendar year per meeting throughout next year. Now, I say that, with a little bit of a smile on my face, because even the Fed doesn't know that that's the path they're going to be on. That's what we're anticipating, and that's what we're expecting. And so that's something that we will work very hard to position the portfolio with that expectation, and then obviously react to the market as the data comes in. One thing I will say, and this is another derivative that we watch, this is the 5-year yield, the 5-year rate 5 years forward. And we use a long-term fair value model. And this is what we have been looking at, as well as several other indicators, that has shown us that duration is cheap, and we want to be long duration. We were anticipating the Fed to cut rates. And so this is just a bit of a peek into some of the tools that we're using to establish our cyclical framework around investing, and some of the things that we're looking at as far as making our investment calls. So being long duration is an investment call that we've had since the first quarter of 2023, and it's something that we feel very comfortable with right now. So I talked a little bit about expectation around long-term neutral. This is the Fed funds futures market. And so these are each contract for each month until all the way out to April 2026. The thing that you can see here is that it does have terminal policy rate by April of 26 trading around 260, a little bit, maybe a little bit higher, 270. Now, again, this is as of September 14th. The market has moved around since that Fed rate cut. But I think the important thing to recognize here is that the long-term Fed funds neutral rate has moved higher from what was expected 2 years ago. And that was that neutral was at 2%, and the Fed, once they began the easing cycle, they would be easing all the way down to 2%. Now, the thought is Fed funds could probably end up somewhere around 2.75 to 3.25. I think that's a reasonable range with what the information we have right now. But as I said to someone recently, the challenge with knowing what the neutral rate is, you don't know it until after the fact. In other words, we won't know what Fed funds neutral rate was until we've either moved through it or moved back above it. And so it's a bit of a revisionist history type of thing, but right now we're thinking that terminal funds is 2.75 to 3.25.
Okay, well, that's really good to know, just as a forecasting standpoint. And just to take a quick pause for a lot of the local governments that are on the line right now, going through their budget and trying to forecast out next year's interest earnings. Well, I think we've established the point today that interest rates are coming down. So whether it's in your liquidity vehicles or in your longer term securities, you really need to be diligent as you're going through your budget process. And really, if we're hearing the numbers and forecasting correctly, a really nice conservative interest rate forecast in aggregate for your local governments would probably be 3.25 to 3.5 for next year, to account for some of the higher rates at the beginning of the year as we roll down that yield curve. I think that would be a nice conservative forecast for your interest earnings as an aggregate. So just to add that little piece in there before we move on to our next question, and we will have some time for questions at the end. But Will, how is your team right now, the State Street team, which I think is a massive differentiator for CSLIP compared to some of the other local government investment pools in the state? You guys are the 4th largest asset manager in the world, and your cash management team is impressive and how you operate, and some of the other funds that you do manage, including the local government investment pool in California, CalTrust. How are you positioning CSLIP right now?
Yeah, we're opportunistically trying to keep CSLIP the duration extended. We want to try to buy up dates on the curve that we think make sense, where we know we can lock in some yields that will be beneficial to the shareholders. And so we're really trying to do that. Now, we have to be careful because the market has been really volatile. And so we really don't want to lock up yields that are what we think are too low given market conditions. We also have to be careful around particular dates or particular Fed speak as far as economic releases, what a Fed governor giving a speech is saying, how the market's reacting to that, what geopolitical events are going on. So, first and foremost, we're always thinking about safety and liquidity. And so that's top of mind for every investment decision we make. But then secondarily, we are considering, what is the best, what can return the best investment outcome for the shareholders. I will say from a credit market standpoint, we're cautious on credit. We are being very disciplined about what we're investing in. We think the banking system is very healthy and very robust. They have a lot of capital, a lot of liquidity, so we feel very confident in the names that we're putting into the portfolio. But if we do end up in a recession and the business sector turns weak, then we want to just be cautious on credit. And so that's what we're doing. We're just being extra diligent on what we're buying, how we're buying it. Perhaps we're going to buy a double A name instead of a single A. Perhaps we're going to buy something that's a little bit more liquid instead of less liquid, that sort of thing. So we're just being very cautious. We're not outright negative on credit. We're just being cautious on credit.
Well, dealing with public funds, you can never be too safe. So that is excellent to hear
Yeah.
that your team is really being aware of what's happening out there. And that, I guess that dovetails into my next question. What are you worried about?
Yeah. No, it's a good question, and I think this is something that we're worried about: volatility. You can see the MOVE index is a measure of 1 month Treasury option volatility. So it's a measure of how much the prices are moving in 1 month Treasury options. And you can see how that's ticked up and has remained higher than it has been since the great financial crisis. And I think the reason is twofold. First is that we experienced a rate hike environment that was like nothing we had seen since the early 1980s. And so that was the first move. But then the second move has just been this economic data transition that we're going through. There's a lot of noise in the data because of the COVID lockdown. There's been an enormous amount of both monetary and fiscal stimulus. And so that has created a lot of volatility in the data. I think probably the most notable has been the non-farm payroll gains that have been revised. So the first Friday of every month, the Bureau of Labor Statistics announces the non-farm payroll gains. So that is workers that have been hired outside of the farming sector into our economy. They do this, it's a survey-based data. And what they do is they establish a trend line and they collect the survey results. But when they release the first release of the data, they only have about 30% of the respondents in. By the end of the next month, they've collected another 30%. And by the end of the third month, they've collected all of the survey data. So therefore, there are a series of revisions that have gone on. And what those revisions have done is dramatically revised lower the amount of payroll gains. So the bottom line is the market is reacting to this, and it's reacting up, down, up, down. And you can see that in some of the yields that I'm sure you folks watch on a daily basis. Some days the 2-year note is up 10 or 20 basis points and then down 10 or 20 basis points perhaps the next week. We saw 100 basis point move in 2-year yields in the month of August. So really dramatic moves and thus increased volatility. So what does it mean for CSLIP? It means that we're being particularly prudent and particularly cautious on how we place our trades for the portfolio to make sure that they are the right trades at the right time for you, the shareholders. So
No, that's
Ben, let
Yep.
me turn it back to you. I have a question for you. So
Sure.
you've spent a tremendous amount of time on the road. The mileage you put on a car in any year would embarrass a taxi cab driver. You are behind the wheel seeing clients, every day, all day. So what are you hearing? You're out on the road. What are you hearing from folks that you're speaking to?
Well, I appreciate that. Well, I think, something that really separates CSLIP from some of the other providers out there is we want to be a part of your community. And I appreciate the opportunity to discuss that. And to Will's point, I've done 5,000 miles in Colorado since the beginning of May. And if I haven't made it to your community yet to sit down with you individually, give me a ring. I'm happy to come and see you. But one of the trends that I'm noticing is that we are starting to see a little bit of a slowdown, here in Colorado, especially from a sales tax revenue standpoint. There are a few outlier communities that are well above the average of 1 to 2% increases over last year's sales tax numbers. Budgets are trailing in that trend right now of 1 to 2% up. Some entities are seeing 3 and 4, but that's not very common. I think the biggest component right now, the biggest challenge that local governments face is cost of living. I mean, that's been really the the trend over the last 5 years, that Colorado is very expensive. We are no longer a undiscovered community. Our net migration is starting to increase. Over the last couple of years, we started to see relatively flat migration in, or in some months, we saw migration out. But as long as people continue to move here and we experience a growing tax base, our housing market is going to remain strained here in Colorado. Our chair, Bill Sutter from the Boulder Valley School District, and I, we contribute to the University of Colorado Business Economic Forecast every year, and we just went to kind of the kickoff meeting a couple of weeks ago, and they're starting to see a slowdown in a lot of the sectors of the Colorado economy. There are still some areas of the Colorado economy that are growing, but really on the local government level, we had a massive challenge that would have been relatively unpredictable with. Let me just let this person one in here. But having said that, with the two propositions that were up on the ballot that have been since removed related to property tax valuations, here has been a big question mark. And now that those have been removed from the ballot, I think that eases a lot of the trepidation that many of the special districts had. That's really where you would see a lot of impact from a decrease in property tax collections at the county level, is trickling down into those smaller special districts out in rural Colorado, namely fire protection, water and sand. What does it mean for fire protection? Well, it would mean decreased response times. And as we've all learned with wildfires out here in the West, a lot can happen in 4 minutes. So having said that, I think that a lot of the tension of political pressures that could have an impact on local government budgets have decreased over the last couple of weeks with the change in that removal of those initiatives. But, again, housing continues to be the problem. A lot of the communities out there, one of our board members is in Mountain Village. Well, how do you get employees to apply to these positions if the communities that they live in are extremely unaffordable, or you have to commute, for a very long time? So I think that until we start to see an uptick in housing, which really brings me to an economic measure that a lot of people aren't focusing on. Well, why is there such a housing crunch in the United States, and namely in Colorado? Well, when you have these second home owners, as well as massive corporations that own a ton of housing, that either rent them out on VRBO or have hoarded them in a real estate portfolio, does that make it easy for the millennials or Gen Z is now starting to purchase homes? If that doesn't make you feel senior like it does to me, it's really an astonishing economic environment that we're in right now, and nobody's really talking about it. Well, why do we have such a housing crisis? Well, we can look at those factors right there. But the great news is that the tax base is continuing to grow in Colorado. But again, that's a double-edged sword that will have an impact on our housing prices, which again really impacts the discretionary income of not only local government finance officers, but also for the commoners here in Colorado, the permanent residents, as I like to refer to us, not the once a week vacationers that use Colorado as a playground. So having said that, I think that we will still see positive trends and economic growth for local governments here in Colorado. But that's really a long-winded answer to your question. All in all, the state is still very healthy. I think that, aside from the decrease in interest earnings at the local government level, I think we'll see an uptick in borrowing, because borrowing costs are going to continue to decrease as interest rates are going down. I know a lot of the communities on this Zoom call today have many capital projects coming up. So if you are in the process of issuing debt, I think that the interest rates have corrected quite a bit, but you may want to just wait a little longer if you can. But having said that, I think that the state is still overall very healthy compared to a lot of our neighbors and the nation as a whole. And we'll see what happens over the next couple of months. But in a way, I do think that it's healthy that interest rates are starting to come down. I think the Fed is, for my own opinion, on top of the pulse of what's happening in the economy. So your thoughts, there were extremely helpful, Will. And I was hoping to ask you one last question here before we open it up to questions in the audience. And please, anybody that's on the call, feel free to pick Will's brain. I've had the privilege of learning from this man and his team over the last 9 months as we've been putting CSLIP together, and we have a great resource here. So feel free to ask him some questions. But the last question I have for you, Will, is where will the Fed's target rate be at the end of this year and at the end of next year? It's the ultimate crystal ball question, and hopefully your crystal ball is cleared up a little bit and can give us a great prediction here.
Yeah, sure. I mean, so we do have 2 more rate cuts penciled in, 25 in November and December. It should be noted that the Fed has moved their meeting. The Fed usually meets on a Tuesday and a Wednesday with their policy rate announcement given on a Wednesday. With the election this year, on the Tuesday of the first day of the Fed meeting, the Fed has chosen to move their meeting to a Wednesday, Thursday. And so I think that's just an important thing. I don't, the Fed has stated continuously that they are politically agnostic and they are impartial and they go about their work independently, which I believe, and I know that they're committed to that. But it is interesting that they have moved it just given the election. And so if there is significant disruption, then the Fed is poised to react. But we do not think so. We don't think that is the base case. And so we think the Fed eases by 50 more basis points this year and then 150 next year with a 25 basis point decrease at each meeting. And I can't emphasize enough how important it is, just given my comments around volatility, to really stay tuned to where we are from an economic standpoint, because this is not the decade of 2009 to 19 anymore, where the Fed is going to be very gradual and consistent in their moves. I think that what we've learned from 2022 and then from this first 50 basis point rate hike just last week, what we've learned is that the data now warrants behavior from the Fed that's outside of the norm. And so we really want to keep a close eye on that. So 50 this year, another 150 next year, possibly with the risk that they do more easing.
Wow. Okay. Well, here we go. Let's just put on our seatbelts and see what happens over the next year. But thank you, for that information. And real quickly, before we open it up for questions here, we are going to be hosting another webinar on October 21st at the same time, 10 a.m., to discuss the differences between bank deposits and short-term liquidity funds like local government investment pools and money market funds. And we will always seek to provide a Colorado economic update as we're out there in the field and meeting with you and learning some of the challenges that you face. We will always try to dovetail those into our webinars. And again, continuing education is something that we really believe in here. Many of you have an office of it's just you and one other person. You don't have an army in your office to really help you make effective decisions, and that's where we can come in. So feel free to utilize us to look at your cash flow, to look at your investment policy if you haven't dusted that off in the last couple of years. These are all services that, we do provide to you, and our participant base is growing. There's been a lot of interest in CSLIP over the 8 weeks, just over 8 weeks that we've been active here. The board was really adamant on providing the state of Colorado with another liquidity investment pool, with another diversification option. We're of the mindset that half the state's deposits shouldn't be in one local government investment pool. So really consider us when you look at your liquidity options. I think that we have a lot of unique differences, which is what you've heard today with Will and his team at State Street Global Advisors. They are the 4th largest asset manager in the world. And on any given day, there's tens of employees there that look at CSLIP in one way or another. So feel free to utilize us. We're here to help you. For all of you that have known me over the last 18 years, you know that when I say that to you, I mean that. So feel free to reach out to us. We are here to help. So with that, I want to go ahead and open this up. We've got about 20 minutes here to open it up for questions. And I know that one of our board members just wanted to share a few thoughts. So Mr. Farman, if you wanted to come off mute for us, and whether you had something to say. So we're going to open it up right after Doug has a few comments.
All right. Well, I just want to thank Ben and thank you, Will, for this important update. Very insightful. I'm really excited about being on the board and serving CSLIP here. I've been doing this for over 30 years, which is amazing because I still don't have any gray hair. But this really is the most exciting project I've ever been involved in. And I just feel very fortunate for the opportunity. And what sets CSLIP apart is not only having the credibility of working with Ben and Will, but we are all committed to incredible customer service. So whatever we can do to help our municipalities here in Colorado, we will try to do the best of our ability. So please reach out if you have any questions. And again, on behalf of the Board of Trustees, we're just very excited about working with you in the coming future. Thanks, Ben.
Thank you for that, Doug. Well, does anybody on the line have any questions? We have a very diverse group from all over the state here, which is by design. No community is too small or too far from the Front Range to be noticed by us, just so you're aware. So feel free to ask some questions. There's no questions that are too big or too small. That is what we're here to help you with. So feel free to unmute yourself, or if you want to raise your hand. I don't know how many we're going to have coming here at once, but we'll open it up to you for some questions. Wow, no questions. That's amazing. Okay, well, we'll give it just one more minute here and see if anybody has the gusto to raise their hand. Okay, well, we do appreciate your time. And again, this meeting is being recorded. We will have it posted to our website within the coming days. So feel free to, you can email me as well. All my contact information was listed before. And please take a look at Will's very important disclosure screen to keep us in compliance with State Street Global Advisors, as well as the state of Colorado on important disclosures. But feel free to email me if I can be of assistance, or if you'd like to see this presentation sent to you where you don't have to download the link. So again, October 21st at 10 a.m., we're going to be hosting another one of these. I will send out another email to remind everybody, but we look forward to seeing you in the coming months and being a resource for you. So don't hesitate to reach out, and thank you so much for your time and taking time away from your busy days. And we appreciate it. Have a wonderful day, everybody.
Thanks, Ben. See you later.
Good.